You cannot trade if you don't know how to identify the trend properly. So in this video, I'll be bringing you down to the basics. I'll show you exactly how to plot the trend from the basics. So what I need you to do is to forget everything you've been told, because this is it. And also like and subscribe. So this is Euro USD on the daily time frame. Plotting this up, what we see right here. Let's try it from really basics. You can see that the market is somehow headed to the upside. Now any newbie seeing this can tell, obviously this is going to the upside. So why is this considered an uptrend? When the market keeps breaking highs continuously, that is considered an uptrend. So what are highs? What the hell am I talking about? First of all, let's use this box and find the beginning of the trend. Okay, let's just say the market you're looking at right now started off from this point. We have this up candle, these candles, which is considered bullish candles, that are heading to the upside. So this point right here, the market getting to this point and reversing back down, that is exactly what you consider a high right here. That right there is considered a high. And once the market violates this high, which means if the market breaks this high and closes above, not the wicks, so these are the wicks, when you can see the body of the market closes above the high, that means we just created another high, and simultaneously we now have a low. Where there is a high, there must be a low to identify an uptrend. So we have this low right here. Now this is considered a higher high, and this is considered a higher low. For this example, I'll just call it high and low. So immediately we broke this high, that is a bullish momentum. We rejected again, creating another high, another low. We broke that same high, creating another high, and then we have a rejection of that high right there, which means this is our high, and immediately we came back to this point, right here, and immediately we broke back from this point. That means we have another higher high, which means this is our low. So I hope you're getting the right here. If we are in a trend that is having an upward direction, then we will be having a high, which is this point, an exhaustion, which is this point, and until the price breaks this current high, can we have a higher high. And once that price continues that pattern, we break the high, we have a higher high. Okay, the lows form automatically when and only if we have broken the high. So that is exactly how to identify an uptrend. So moving on to, let's just tackle this problem now. You can see that we just broke the current high and we created a new high. Now this exhaustion happened. Did we break the current high? Because this is the current high. Remember, we created a high and then performed an exhaustion. So this is the high. Now, as I said, until we break this high right here, then we have not had any lower low whatsoever. But immediately we came back to this low, because you can see we came back to this structure that this high has created, and we failed to crack that. We came back to this low that has created what is called a double top and a double bottom pattern. For this example, this is a double top pattern. For those of you who don't know what the hell a double top is, it is just exactly what it's called, a pattern that looks like the letter M in the alphabetical English language. It looks like the letter M, and that is exactly what you see here. And immediately that pattern, that the price breaks the neckline of that pattern. What exactly is the neckline? This point right here of the double top pattern. So you have the first top, the second top. Immediately price breaks that, creating the letter M. That means we have a trend reversal, and that is exactly what happened here. We broke this this neckline of the double top pattern. And immediately we broke that neckline. Now we shifted to the downtrend. How do we identify the downtrend? With everything that I've taught you right now and how to identify the uptrend, that is still the same principle, but for this instance the market is heading to the downside, which means we are somehow falling. We have the downward direction. So what do the market do? What does it exactly do for us to consider it a downtrend, a bearish momentum? If the market keeps breaking the lows, remember the highs, the uptrend needs a continuous breaking of the highs, the downtrend needs a continuous breaking of the lows. So what exactly are the lows and what are the highs? When you can see a down momentum like this and you see the price is pulling to the downside and then exhausting, if the price breaks this downward structure right here, then we have a low. That is exactly what we are seeing right here. You can see exactly, to do a minute recap right here, we were heading to the upside because we indeed were breaking the highs, and then we had this double top pattern which I explained earlier, and we broke the neckline of this double top pattern, which is exactly here. We broke that neckline and then we adjusted down to this point. I mean, immediately we got that bullish exhaustment, then we have a low. This is the low. It's just the same thing with the uptrend, but this time around is flipped upside down. This is considered the lower low. We'll just call that a low, and this is considered a high. That is for the downtrend. And once the price keeps breaking the lows, heading to the downside, that means we are in a downtrend. So this is a low. This is also considered a high. We broke that to the downside, and you can see low, high, low, high, low, and then we have this bullish momentum breaking the neckline. This is the neckline, breaking the neckline of this double bottom pattern. So what is exactly a double bottom pattern? A double bottom pattern is the same thing as a double top pattern, but this time around it's the letter W in the English language, the letter W in the English language. And when you have these two lows, one failing to break the other, and then you have the break of this neckline right here, that means we are transitioning into a bullish momentum. We have a very strong bullish momentum entering into the market, and you can see exactly what happened just right after the breakouts of this double bottom pattern. We have this bullish momentum, very powerful bullish momentum. Moving on, the next thing you will need to learn to strengthen your knowledge in identifying the market trend direction is the key zone areas. You can also call that support and resistance, but let's just call that support and resistance because that is more popular. So what exactly is the key zone? What the hell is that? So starting out from this point, this double bottom pattern, immediately we broke out of that range. This low and this high right here, those are the key zones in the market. Those are the zones where you need to place your support and resistance, and those are the zones where you need to trade from. So generally it's just your lower low or lower high, and you can call this, it's just your low or high. Whether you are in an uptrend or a downtrend, it's the same thing. Your key zones will always be a low and a high. So generally when you have this low, high, low, high, low structure in a downtrend, what are the key zones? The key zones are just your lows and your highs. Those are the key zones that you are supposed to be looking at in the market. Why these zones? Because they are incredibly powerful. The market has used these prices in these zones to redirect itself. So the chances are high that when the market comes back into the price, it's going to reject properly off that area. So that is the second thing you need to know about the key zone, because if you cannot rock the trend around other factors you use for trading, it could be other confluences, then your strategy is not properly aligned with the market direction. The third thing you need to identify is a range. So what exactly is a range? You know, the way we have an uptrend and a downtrend, a range has no direction whatsoever, and it is an indication that you need to stay off the market. So how do we identify the range? Well, obviously when the market is failing to create a low and a high, a low or a high, you can see we were continuously creating lows right here, and then we are failing to create the low right here, and immediately we broke out of this range. Immediately we broke out of this range right here, we have an upward momentum. But what happened during this time period? What exactly was going on right here? Because we weren't creating any lows, there were no candle closing below, and until a candle closed above, we had a very strong upward momentum. You can see that phenomena still playing out right here. At the top of this uptrend, we have the double top, and then we have a double top breakout. This right here is the low. Until we break this low, then we are not having a bearish momentum. So as this is the low, so let's make this extremely clear right now. This is the high, this is the rejection, this is the double top of the high, the first top, the second top, this is the neckline. Immediately we broke that neckline, this is considered our lower low. I want this to be clear. Because we have a new low, where is our high? Because you cannot have a high without a low, and you can also not have a low without a high. So this is our new high. You can also call this a turning point. Is our high, and the moment we broke this neckline, we transitioned into bearish. Now you can see that we are failing to break lows, and we are also failing to break highs. Even if we broke this high, we created a new high, but have we broken that high yet? Nope, we have not broken that high. So this is the perfect example of a range. You need to stay out of this mess, and only if, has the market broken a low and comes back to retest that low, should you be looking to sell. And only if a market breaks a high and comes back to retest that high, should you be looking to buy. So to just rush through what I just said so you can understand that, you can tell obviously this is a high, because indeed we're heading to the upside. This is what I'm talking about. Only if the market breaks the high, comes back and retests that high, this zone right here is where you should be looking to enter your trade. This zone, you should be looking to enter this zone and a long position, which means you're supposed to be buying at this retest of this high right here, because that is a very powerful upward momentum, and you have a lot of chance. The probability of hitting that trade is a lot higher. For the downward example, when you see this can be considered a retest as well. When the market breaks this double top right here, and then we came back for a retest at this zone, that is a very small retest, but we are in the daily time frame. If you jump down to the 4H time frame, you can look to enter at that position, targeting a sell trade. Why a sell? Because we have a downward momentum, but in a range we are not breaking any structure, and since we are not breaking any structure, we are not having any retest or any exhaustion to a key zone. And also that is an indicator that there is no momentum that is currently dominating the market. You know, when the market is heading to the upside, then the buyers are dominating the market, and you should trade along the buyers, which means you should be buying. vice versa. If the market is heading to the downside, the sellers are dominating, and you should sell with the sellers. But as for a range, no one is dominating. It's like a power tug, and you need to stay out until we have a direction in the market. So that is exactly how to identify a range, and this is where most trading strategies fail. Most traders, they typically ignore the daily time frame, or if you are trading in the 5 minute, or if they are trading in the 5 minute time frame, they ignore the higher time frame. They're supposed to be trading with the higher time frame direction in order to identify if they are trading in a range or a trend, because it's a market condition, and no matter the system you use, you are going to be affected by any market condition. Every single market condition affects every single trader, no matter the kind of trader you are. So it is important for you to be able to identify if you are heading to the upside or downside, or you are just moving sideways like this. And once you start moving sideways, you should stay out of the market, as I mentioned earlier.